Don't connect with me, but please follow me on LinkedIn. So what are the top trading tactics? I know you've got a whole load of other goals you've got for this year, but let's look at the top trading tactics. I've already told you before why I trade. I think it's the best entrepreneurial business in the world. Okay, because there's no overheads, there's no offices, there's no workers, there's no insurance, there's no warehouse, there's no logistics. Basically, if you make money, it goes straight into your bank account. There's no sort of waiting and chasing up creditors and all the rest of it. And it's eventually you realize, oh, actually, it's not just about the funds, it's about the freedom and the fun and hopefully eventually the philanthropy as well. So let's get into that. No, that isn't me going to a party in one of those pictures. Enough of that. No jokes, please. Okay. Aberdeen in beautiful Scotland. Okay. Wonderful, wonderful, wonderful. Michael, you were just on the Pepstone one. Now I'm here. Ravi, of course, my friend Ravi, Paresh, Germany, Frankfurt. Dominic, my business partners are in Munich. Edmonton, Anakin, we're speaking on Friday, I believe, Anakin. So this one about trading, not investing, just in case I've got a whole bunch of my investor side people. This is for trading. So let's look at the S&P 500. Just give a bit of market context. I want to give you a market context. Then I'm going to talk about trades that we've got on at the moment, which ones are working, which ones aren't working, how do we minimize the non-working ones when it comes to trades, and why trading fits in really well for us, given our investment portfolio, our portfolio that we're holding over 12 months. So this is the S&P calendar year returns, and you can see what the returns have been. You know, anything from 29%, 18%, 31%, and so on and so forth. And you can see the years down here, and the black dots are the drawdowns. You know, just the how much intra-year the decline can be. You know, minus 34%. Good God. Okay, and it just shows you can have massive drawdowns and yet have an up year. I don't know. I'm not saying this is necessarily an up year. All I'm saying is, given that you can have these moves down, is one of the reasons why people like to trade, because they think to themselves, hang on, I've got my buy and hold portfolio. Put that to one side. That just keep that separate. That's my 12-month holdings. Then we do it again. Forget investments for a moment, okay? Trading, the reason people want to do it is they say, well, if we're going to get these big drawdowns during the course of a year, I want to trade for two reasons. One, we might have a multiple number of years where the market's negative. So my buy and hold investments go nowhere, let's say, because the markets are going nowhere, potentially. Therefore, if I'm trading, I can make more money. Secondly, they do it because they say, well, intra-year, you can be down quite significantly, so I can sell high, buy low, trade that, and I'll explain that in a second. That's one of the other reasons why they want to trade, because even if it's an up year eventually, they know they've got all these opportunities where the market's going up and down during the course of the year. S&P 500, let's just have a look. I want to show you something interesting I found. This is the price of S&P 500 stocks when the last financial crisis happened, which was 2008. 2008 was a negative year. So did any of those stocks go up? Actually, there's a whole bunch which went up, but not many, okay? Not many, but they did go up. This is their performance over the last couple of weeks. So they're not going up at the moment. They're not going up at the moment, other than Vertex and Amgen. So again, another reason why people want to trade alongside what investments they might have is they say, well, I want to turn some of these falls into profits. I want to sell at a higher price, buy a lower one. How do I do that? Is it stocks? Is it foreign exchange? Is it commodities? Doesn't matter what it is, because everything, profits are the difference between one price and the other, the sell price and the buy price. Okay, that's what profits are, or between the buy price and the sell price. Doesn't matter which order you do it in. So in a way, I don't care whether you make your money in Forex, stocks, indices. I really don't care which one of those it is. So how do we decide what we should trade at the moment? So I'm going to go through and I'm going to show you some of the things I've got on the screen at the moment, everything from FTSE to currencies to individual stocks to cryptos even, and why and how you decide which ones and what time frame. So I'm going to go into all of that. Thank you, Michael. Thank you. Hey, Wade, Chesapeake Beach, Maryland. I hope to meet you one day. Malta, Michael, got people from all over the shop. This is fantastic. Okay, so when we did this, we said, well, this is another case why people might want to trade. By the way, the same figures for the Dow, and you might want to take a photo of this. So I looked at the Dow, and it's only got 30 stocks in it, the Dow, okay? What's the price during the last crisis? Which ones went up, if any? Well, there were only a couple of stocks in the Dow 30, today's Dow 30, because remember back then it would have been slightly different stocks. Amgen in today's Dow 30 was up during the market financial crisis, and actually it's been up in the last couple of weeks. But other than that, these are all down. I mean, there's nothing which was up then and up in the last 2 weeks other than that one. That's not to say buy Amgen. That's not what I'm saying. What I'm saying is this is why people want to trade, because they're saying, well, I'm seeing all this blood. What am I supposed to do? Just sit back and take it? Am I supposed to continue just getting slapped in the face? Okay, well, of course not. And another reason why people are looking at trading even more so at the moment is this. There's some forecast. This is the S&P 500 again, okay, going all the way back to 1990 when I was at university. My God, all right? And you can see there was a 39% drop in 2008. The data that I just showed you, there was from 2000, 2002. I was doing my weekly Bloomberg show on Tuesdays and Wednesdays then. So we lived through this. And every single week we'd commentate on the markets and how it was falling. And also, I was writing my weekly column in the Financial Times during that period, the Diary of an Internet Trader. So I was describing what was happening. Now, for all the people who, you see these newspaper headlines go, oh, and this is Mr. John Smith. He predicted the 2000 crash. Can I just tell you something? I was there at the time. Everybody, including my aunt and my dog, predicted the crash. We all knew it was going to fall. We just didn't quite know which day was going to be the first day of the falls. If you remember back then, everybody kept saying it's a bubble. It's just that they kept saying it during all the rises. It was a bandwagon. The trick with any bandwagon is not to go anywhere near it. It was to get off before it fell off the cliff. And I kept saying that on Bloomberg, saying, look, today the bandwagon's still going up. I'll let you know when it's falling off the cliff, and then we jump off. And we probably would have started saying that around here-ish, because it was clear that that upward trend was well gone. We wouldn't have picked the exact top. Nobody I know ever did that. But the point is, if we get this 50% drop, then that's another reason people want to trade. Now, I don't think that's going to happen. And by the way, a 50% drop in the S&P would only take us back to where we were in March of 2020. So it might sound like a lot, 50%, given historic drops, but actually, it's actually just the recent past. So it's not that bad in one sense. I mean, not that bad as in it's more likely because of that, but it's not that bad as in we're only just there the other day, as it were, in March 2020. But it's another reason why people are looking at trading, because they're saying, well, yeah, I'm going to keep my good quality stocks. Let's just take, for argument's sake, just take it as read. Let's say Microsoft is a quality stock you hold, okay, for argument's sake. Well, they'll say, well, I'm going to keep holding it as quality stock. I'm not going to go totally into cash. But what I'll do is I'll trade. Let's see how we're going to do it. That's what this webinar is about. How will you trade to supplement your investments, or just trade? You might have no investments. And that's the S&P, what you see in red at the bottom of the drawdowns. And you can see, look, I mean, where we are at the moment is only here. Okay, look at how far it's been in the past. A hell of a lot more than it is at the moment. That's not to say things are going to get worse, although I think that's more probable in the near term, in the next week or 2 weeks, than, oh, this is it, we've had the worst of it, markets are up today, that's it, it's bottomed out. I wouldn't be bold enough to say that. So like I said, either way, when you're trading, you don't care what's going to happen in a year. When you're trading, you're saying, I don't know if it's going to be up or down, I'm going to go with the trade direction. And that, again, is what the webinar is going to focus on. Okay, by the way, just to make things worse, this is the worst start ever. This is the NASDAQ 100. It's on track for its worst January performance. And yeah, not good, is it? These are the other Januaries it's had. Actually, it seems to be, it has as many up Januaries as down Januaries, but this one looks pretty bad. Anyway, if you're thinking, and this is just to give you context before we get into the nub of the trading part, this is US equities. They've not been overvalued since the dot-com bubble. This is just one measure of valuation. That's where the US equities are. The valuation or overvaluation is, and it's well beyond what might be called fair value, okay? It's not quite at the peak of overvaluation of the dot-com bubble. So you might say, oh, great. And by the way, don't get me wrong. I wish the markets would just keep going up and up and up in a smooth diagonal line. Okay, I wish that, because my life would be easy. I'd just go sit on a beach all day and say I don't have to do anything. This is easy. It's just going to keep going up. So I know, I'm upset when it doesn't keep going like that, because I have to work and trade and look at other investments and keep an eye on things, right? Well, sadly, that's the way it is. This is the S&P 500 against the historical average. Again, it's just showing the other picture in a different way. It's valuations of the market, so the price earnings ratio. It's not quite as bad as the internet bubble, but it's pretty bloody high, and it's 2 standard deviations from the long-term average, which is another way of people saying, yeah, I can see why the market might want. Well, let me put it this way: people have got an excuse to sell. Okay, and by the way, this is from a behavioral finance document, which I've been using since, well, about 2001, because in 2001, I was a visiting fellow at Oxford University where I was lecturing on behavioral finance. And this is probably one of the most important slides. And I dug it up and I wanted to share it with you. So imagine this is the price, okay? It's going like this. And then it falls a bit. Now, why did it fall? And there's earnings season in the US at the moment. Why did it fall? One of two things can happen. If the news was soft, in other words, it was just, you know, forecast plans, nothing really hard, it'll probably resume up. Now, this is the kind of thing a Microsoft will do. Microsoft had blowout numbers yesterday, but it fell. Okay, so it's probably going to do more of a V-shaped recovery. If the bad news is hard, like profits warning, downsizing, you know, real problems, and I try and avoid companies which are ever going to have those kind of things because I look for cash flow rich companies, but we're talking about trading now. Okay, not investing, then it's more likely to fall like this. So how do we pick this? You know, why do people want to trade? Well, because there's a lot of this going on. There's a lot of this falling going on, as you know, right? To labor the point. Another reason they want to trade is they want more than just returns that investment can give. They know investments, and this is the S&P 500 calendar year returns, are likely to give, even in some years, just the index. If you just track the index, forget if you're doing better than that, you get 30 to 40% in a minority of years with the index. Hopefully you can get 40%. You can double the index. Let's say you could double the index. Okay, just take that as rough and ready measure. Then you also still know it's a minority of years where you double the index and you still get your 40%. And even here, so what they're trying to do is they're trying to say, well, what about all these years when the index is falling? I still want a positive return. I want a positive return. And again, that's why they're looking to trade, okay? So I want to give you some context. Before we look at how we trade, what trades we've got going on live at the moment, this is the S&P 500 again. And it goes back over 10 years, okay? You might want to take a picture of this. By the way, throughout this, you might want a camera phone. And I've marked A, B, C, D. A is the S&P 500 just carrying on in the trend it's got. Okay, I think that's unlikely. B is where it goes into a longer term trend that started 10 years ago. So it has deeper falls, everyone panics, but then it still goes back to an upward trend. I think that's most likely. C is where it falls to a deeper support and still everyone's panicking. D is what the people who think it's going to drop 50% are saying, and I think that's a minority likelihood. I don't think that's very likely. I think B is more likely. Okay, so that's another reason, you know, because if you've got the next 6 months of it just tracking lower and then growing gradually back, the investors are thinking, oh, I've got to wait. Whereas you know, can I do something else about it, Alpesh? That's where they want to trade as well. So for us, what's critical is trade selection. We go for the easy trades. We go for the ones with the smoother trends, which look more like this, you know, simple, smooth, straight lines, you know, what look like straight lines, either down or up. And we look for certain time frames that work for us. And I'll list those, but just so you know in advance, 15-minute bars. So each one of these bars would be 15-minute or 30-minute or 1 hour. So 3 time frames and a certain number of products. I'll break all that down for you and I'll tell you what we're looking at. Essentially, we're just looking to buy low, like at 122, and sell higher. So this is 136, and we're looking to do it. That's in 2 days. So we got in at 122, got out at 136. Okay, great. You made 14 odd points. Well, if it was £10 a point, you made £140. If it was £1,000 a point, you made 140 grand, right? If I've got my maths right. Sorry, 14 grand. You made 14 grand. You're not going to do £1,000 a point. Sorry, stupid example. Okay, or you sell at 130, you buy back at 122, so you made 8 points, 8 points profit, right? That's the point of it. Now, I know some of it's basic, but I got to give you a warning because before I make it sound too easy and basic, and how do we know when to get in? How do we know when to get out? What are the rules? What are the strategies? There's a warning. Most people lose money. The majority lose money. Let me say that again. Warning, in trading, the majority lose money, right? These are screenshots from 3 different brokers. I think it was IG, Saxo, and Intertrader, I think, were the ones I picked, but they're all pretty similar. they roughly, because they all look at what each other's offering, and they try and keep their losing accounts to about the 60%-ish mark, well, 60 to 70%. But that still means about 35% are making money. So if about 35% are making money, let's see if we can get you into the 35%. It's not getting you into the top 1%. That'd be hard. Not the top 10%. That'd be hard. Not even the top 20. Just the top 35 who are making money. 35%. Get you into that category. That's my job. Watch to the end. I'll make sure you get a little gift. And this is essentially how traders are losing money. What they're doing is they see that 100, they see that 80, they say, oh, I'll just put a profit level at 200 and I'll make money. No, you'll still lose. Because if you do this, and I want you to practice this at home as a statistical example, you'll lose money. All right. What we're going to do instead is say, well, look, let's just say the prices have a 50-50 chance of going up or down. Well, we're going to lose money. All we're trying to do is just put the odds slightly in our favor, just a tiny bit. Okay. And I'm going to show you the strategies that winning hedge funds have, which you can copy, which just put the odds slightly in your favor. Not much. I can't say, oh, I'm going to show you something, which means you're going to win every single time and every trade will be a big win. No. Okay. If I'd worked that out, that'd be amazing. Well, I'd have the Nobel Prize in economics. All we're going to do is a few tactics which will put the odds slightly in your favor. That's it. A tiny tweak. That's all I can promise. Nothing else. But that tiny tweak will be a big change for your trading. That's the thing. Okay. And we're going to use a free platform. It's broker independent and it's free, because I like free things. Okay. So I'm going to show you this throughout. Okay. And we're going to look at certain things like PayPal, for instance. Now, that was a sell signal for us on PayPal. Any red arrow pointing down is where we get a sell signal. I'll explain why that was sell. That was wrong. That trade didn't work out because it was a sell signal. Then the market went up. That was a buy. Buy signal went up. Now it's down. So we're short. And this is on air. So this is live because that signal's just come in. We're short PayPal right now. And I suspect the markets are going to start dropping because they have. So that's PayPal. And we'll continue with that. But there's others, all right, which I'm going to show you during the course of this. So how do we know when to buy, where to put a stop loss, when to sell? Is it worth our time? Let's look at a business plan. I'll show you a business plan as well. Okay, we're going to look at Tesla, FTSE as an example as well. And just for those who want to know, that's the FTSE. Each one of those bars is 1 hour. So there was a lovely little short there. And there's been a lovely little long. We've lost some of our profits since then because it's pulled back. My exit. Because we might look at this and think, oh, God, everything's indicating it's going to go low. Why should I wait till it hits my stop loss? I'll just get the hell out, bird in the hand. I'd rather have that than two in the bush. I'd rather have an opportunity cost and a certain gain than an uncertain gain and a potential loss. Okay, so that's how you do your trade-off. And we'll also look at currencies. We'll look in this webinar at the S&P 500, Amazon, Ethereum and Microsoft as examples, but there's a whole load more we could have done. I mean, look, you've got so many currencies, you've got so many stocks from McDonald's, Morgan Stanley, Snap, Spotify, Twitter, Uber to UK companies, Barclays, Vodafone, and so on, and cryptos and everything else. So we're just going to pick those as examples at the moment, and we'll keep an eye on PayPal. Should hopefully continue forward. I say hopefully. I'm a long-term holder in it, but I make the profits on the short-term shorts, which will cover my long-term anyway. And in the interim, it hedges that. So hedge. So in the interim for those shorts. So again, why are you trading? Look, that's the buy, that's the sell. You, me, George Soros all get the same data. We've got two decisions to make: when to buy and sell. So why do 66% of people in your position lose money? What are you doing wrong? And since your data is the same and you've only got the same two decisions to make, because actually what should happen is the difference between you and Soros or any hedge fund manager should be just the amount of capital you've got. It should not be that you're so much more likely to lose, given that you've only got the same two decisions, you've got the same data. In that trade, a trader might make £500. A wealthy trader, because he's got more capital, might make £5,000. A professional fund manager might make 200 grand. Soros or a big bank might make $1 billion in that trade. I don't know. Okay. Some of my investors in my hedge fund who also trade on their account would probably make 5 grand in that because they're going to trade bigger amounts because they're wealthier. That should be the only difference. And incidentally, distribution of monthly returns. This is what it should look like for you if you're trading, because this is actually taken from what was hedge fund of the year about 3 years ago. My mentor, Bill Lipschutz, who I first met in 1997, it's his hedge fund, and that's his results. So your distribution of returns should look like this. You will have months, look at this, months where you've got losses. See that? Because he has. You're not going to do better than a professional fund manager. You might say, oh, forget it, Alpesh. No, I only wanted winning trades and winning months. Forget it, I'm off. Fine, that's great. At least now you know. Now you know it's not for you. But for those for whom it is and say, hang on, I want to listen a bit more to this. Okay, you're going to have months where you get small wins, which will be basically countered by the months you have small losses. What's the trick to profitability? By the way, he's a billionaire. How do you get to a billionaire status? It's really simple. There's two things. One is you have no big losing trades. So we're going to show you how in your strategy you avoid big losing trades, okay, through some simple rules. And I'm afraid it's only going to be 20% of your trades, which will generate 80% of your profits. Because look, all these trades get canceled out by the losing ones. So the small wins get canceled out by the small losses. It'll be these which will generate your profits. So we've got to make sure we've got a way where we're not capping profits by having some stupid reward to risk ratio, which puts a cap on your profits. We don't cap profits. If you find oil in your back garden, you don't put a cap on it and go look for oil somewhere else. Duh. Okay. So that's where the profits are going to come from. And the way we're going to keep the profits is having this empty on the left-hand side, no big losses. That's it. Right. And that's it's a hedge fund called Hathersage Asset Management, and theirs is exactly the same as every single profitable hedge fund in the world. In fact, if hedge funds distribution monthly returns don't look like this, it's a massive red flag that there's some kind of dodgy dealing going on. It's as simple as that. It is as simple as that. Okay, and you might say, wait a minute, why can't you just, but you're clever, why can't we just have big winning trades all the time? Why can't it just be only big winning trades, no losing ones? Well, I wish, but you'd need a time machine for that. You know, George Soros, I mean, I don't know, Warren Buffett, George Soros, whoever, it always looks like this. Always looks like this. Because nobody's cracked how, not even with supercomputers. Okay, Renaissance Technologies, probably the most successful fund in the world ever, looks like this. Right, and that's Hathersage from my mentor, Bill Lipschutz, who was global head of foreign exchange trading at Salomons. So presumably somebody who was bloody good, global head of Forex trading at Salomons when they were the biggest Forex trader in the world. That's his performance. That's as good as it gets, okay? And you're not going to do better than that sitting at home alone. So we've got to work out, well, how do we replicate no big losses and a few big wins, which we can allow to run, because those 20% of big wins will generate 80% of our profits. Put another way, in the words of Soros, it's not whether you're right or wrong. It's not whether you're right or wrong, but how much money you make when you're right and how much you lose when you're wrong. That's what I'm talking about. Take a picture of this. When we did the research, not just amongst the hedge fund managers and the people that I had in my book, Mind of a Trader, and the books which have been published by the Financial Times like this, Trading Online, and I've got interviews with hedge fund managers in there, and also I set up my own in 2004 and just copied what they. By the way, I just copied what they did. I mean, if we're not innovative, I do not want to be innovative with other people's money, let alone with my own money. I just want to do what others are doing, which works as long as it works. So this is what we found, and we also found this with retail clients who are making money. The traders, i.e. the profitable ones, the 40% who are profitable, were doing this, and the gamblers were doing this. So what were the traders doing? They trade with a small position size relative to their capital. I know what you're thinking. You're thinking, hang on, Alpesh, you met some of the world's leading traders. Surely when you asked them, how did you get rich? Please tell me. And you published the results in your book. They said, oh, we took some really big bets. Because, like you watch on TV, a series billions. Yeah, we just walk in and we say, right, just buy it, put everything into it. That's why I'm not. No, they weren't idiots. They didn't do that. They wouldn't be allowed, by the way, from a regulatory perspective, let alone all sorts of other rules. They traded small relative to their capital. They did a lot of small trades. Now, that was a surprise to me when I met them, because, think about it. I was straight out of university, meet some of the world's leading traders. I'm hoping they're going to say to me, oh, we do a few big bets. That's how you do it, son. You make it really quick. Stick with us, son. You'll get there. They didn't, and that's not what happened. Okay, this is what happened instead. They told me this, a lot of small trades. How much easier life would have been if they said, oh, everything we touch turns to gold, we just do a few big positions and that's it. I wish they had said that. They didn't. They said they have to work hard, which is why they turn up to the bloody office, do a lot of small trades. Actually, what they said is, what Kaveh Alamutai said, and he was at Tokai Bank, he said, you know what, most of my days just sat there reading the FT. I've got nothing better to do because we pick one good quality trade a day. That's what he said. I couldn't believe it. I thought he'd be saying, oh, yeah, the reason I look tired, he goes, I've got to look exhausted. Otherwise, I don't get the big bonuses. He was the highest paid employee. He lived opposite me on Hamilton Terrace in St. John's Wood, literally opposite out my window. It's so frustrating to sort of see the highest paid employee, which reflects on his property, not mine, by the way. Follows the trend established in the market, never adds to a losing position, starts small size in a trade and adds to it if the trend's more important. In other words, never adds to losers, losers add to losers, write that down, winners add to winners. So I'm going to give you some of the tactics that we learned, okay? A string of losing trades, such as, imagine you're throwing heads a coin, right? And imagine heads is a profitable trade and tails are a losing trade. A string of losing trades, a string of tails would not impact their account much. With gamblers, a string of even 3 losses would mean their account's down 10 to 50%, right? When it's come to trading, right? This is what happens. So let's look in more depth at what it involves. What are some of the tactics, right? So this is what we're going to look at. I'm going to explain to you how we know when to buy there. Notice that green arrow, and I'll share the strategy with you so you can follow and copy the manual rules. I have 10 strategies. This was the earliest and the first one, developed in 1997, and then improved a bit, tiny bit here and there. And it's thanks to Bill and meeting him that all of that actually happened. Okay, so what that did back then, what that strategy did, that entry, look, notice how we didn't get in at the bottom. Well, we don't have a crystal ball. We can't see in the future. We didn't get in there. We got in at that point because that's when we were signaled it was enough momentum that we should get in. But that bit I'll come to. The first thing I want to tell you is this. All good trading involves, from the hedge fund managers we spoke to, involves these characteristics. First of all, okay, we'll put the entry to one side. Okay, let's start with B, point B, which is the stop loss. What is that? Well, rule number 1, losers add to losers. So we never add to a losing position. Rule number 2, how do you know where to put the stop loss? You use a volatility-based stop loss. What does that mean? That means the more volatile the market, further away the stop loss. Now, there's all sorts of ways of doing that. You might say, I'll base it on a recent low. I'll base it on average true range, ATR. Look it up. I'll base it on just observation and experience. Whatever it is, the principle is it can't be too close, otherwise you'll be stopped out by noise. It can't be too far, otherwise it'll be meaningless, right? But you've got to have one. So that's your rule of stops, volatility-based stop loss. But you might say, wait a minute, that means if the stop loss is further away, and let's look at the volatility recently, if the stop loss is further away, surely I'll lose more money. No, because if it's further away, you'll reduce your trade size so that you don't risk losing more money. The reason that's ingenious is because then every stop loss is bespoke to that position. Secondly, you're not risk losing more money just because the market's riskier and more volatile. That's why it's ingenious. Let's just look at some of those trades. So if we look at, for instance, the FTSE, and as you can see, it was long there. That's the stop loss yellow line just off camera there. By coincidence at a recent low. Is it coincidence or is it just how things are programmed for us? So that comes in and you can see there's ample room for the price to go up. Okay. That's the principle of it. And if you're a beginner, you might just have a fixed stop loss at point B and a fixed take profit at point C. If you're more intermediate, then you'd have that stop loss. So when the price goes from A to C, you just move it up, and your broker can do that. They'll tell you how to set that up. And if you're advanced, then you would do what I just described at intermediate level, but you'd also add a new position at point C. Why would you add a new position? Well, winners add to winners. And when you're more experienced, you realize that actually, if you get onto a trend which is working, and here's the important thing, it means that if you know you're going to add to a winner later on, then you're risking the profits you've made to make more money, which is a hell of a lot better. It's a hell of a lot better position than risking capital. So you can start small in case the market goes against you and you have a loss, at least it'll be a small loss, knowing that actually if it goes to point C, you can add to that and it can go up even more. So winners add to winners, losers add to losers. And that's how we're going to develop. So I'm giving you little bits of the strategy and we'll bring it all together at the end. The tactics that the profitable 30% we found used and profitable hedge fund managers used. Let me put it another way. Which is this. Look, the market's going to do one of 4 things. Either it goes up and then up some more. Now, the difference between a professional and an amateur is this. When it goes up a bit for a professional, they're going to add to that winning position. An amateur is going to get spooked and say, oh shit, it's gone up, I'm taking my profits. Okay, so a professional is going to make more money in that scenario. Or it might go up and then go down. Well, in that scenario, a professional will have added, it's gone down, broken even, oh well, never mind, and have got out. An amateur will just stay in. It's not worked out, but they've just stayed in longer than they should have done. They've now got no strategy, and guess what? Sod's law, it will go down and down for them. Or alternatively, the market might go down. Now, a professional in that scenario won't add to their losers. They'll get the hell out. An amateur will say, oh no, it's gone down. Oh, look, I'll stay in. It's gone up again. I'm okay. Look how clever I am. Then they stay in, and guess what? Sod's law, they get to this down and down scenario because they can't avoid it. Their strategy hasn't no exit for it. So let's say the market goes down and down then. Well, a professional gets out at that point, midpoint, because it's hit their stop loss, they're out. Guess what private investors do? They either hold on and then they get bigger losses, or worse still, they add to their losers. So 4 scenarios that the market can have. Your tactics, even though you've only got 2 decisions, when to buy, when to sell, lead you strategically to lose money. A professional doesn't. Okay, not every trade. We just don't lose big. We'll only have small losses. And when we win, we'll have, yes, some small wins, because guess what? Donald Trump used to do a tweet, and our win, which we thought was going to be big, suddenly didn't become big. That's out of our hands. But we'll have 20% big wins, which is what accounts for 80% of our profits. Can I, right at the end, by the way, tell you about technology? My firm, we spun out of the hedge fund, and some of you will know this if you come on my webinars. And I've talked about it on TV and on the internet, but I want to tell you about some of the technology we spun out. You don't have to stay to the end if you don't want, but I'm just saying. Now, this stuff works. Okay, so please pay attention. And by the way, I'm not the first hedge fund in the world to demystify what we do. We've got 10 different strategies. I'm just telling you the rules behind our earliest one. And if you think that means we're going to be out of business, you're wrong. Okay, because we're not the first ones to do it. Man AHL demystified theirs, right? And they've got 19 billion under management. These are all hedge fund managers who use the same strategy in broad terms as us. Not the exact same rules, because I don't know what their rules are, but they all use what's called trend following on momentum, i.e. buy low, sell high, based on momentum. Okay, so they're all momentum. John W. Henry owns Liverpool Football Club. David Harding of Winton just became Sir David Harding in the New Year's Honours list. And Man Group is British. So there's some British and there's non-British ones in here. And they're all using the same technique, trend following. All right. They're not the first. They're not the last. Citigroup have done research on trend strategies. Do they work long-term? Simple trend strategies over prolonged periods of time? Oh, by the way, short answer, yes. Right. This is Winton, which is Sir David Harding's outfit. And there you go. That's one of his slides, not mine. And I'm just explaining that this is exactly what we do. We look for the start of a trend. We don't know that's the start. That could still have kept falling. So we end up getting in after a lag. Yeah, people go, lag? No, I want to know ahead of time when I should buy. I like catching falling lives. We don't do that. Oh, I like time machines and crystal balls and astrology. Nope, we don't have that either. So we can't get in there. We end up getting in the same place Winton do. In fact, what we're trying to do is ride their coattails. And everybody else who's trying to follow trends, we're just trying to ride their coattails because we know they'll move the market higher once the trend started, because we know what their strategies are. It's trend following. They told us, look, there's the bloody slide. So we're just trying to copy them and get in on it. And then we end up getting out, hopefully, around the same time they do. That's all we're trying to do. Okay, it's like somebody gives you a Coca-Cola bottle, but says, I'm not going to give you the recipe, but this is what it tastes like. You could, with some clever scientists, say, okay, I can make something similar. And that's all we're trying to do. We know that's their strategy. We can look at the prices because we know if you buy low, sell high, you make money. We know that's what they've said. We don't know what their precise entry rules are. We just deconstructed it. That's all we did. Okay, and said that's what we want to do because it's simple, right? That's it. And we now use algorithms to do that, but I'll give you the rules. And algorithms have made compressed trading time. Okay, so they've reduced how long it takes when you're trading. Okay, so what algorithms have done is, let's just take Microsoft here for a second. By the way, we're short on Microsoft, and that signal came in, I think this is 15 minutes, so 15, 30, 45. That would have come in just around the start of the webinar. Okay, so that's a short signal. Microsoft was still short on it. We were long before, we're now short on it, and we were short on it on the 20th of January, and then long. And this, by the way, this was great. That falling price in Microsoft was good for us because also, although it hurt us in our long-term investments, they were long-term investments. On our trades, it meant we paid for some of those long-term investments by that fall. And similarly, this was going up. Well, fine. We had a choice whether to go long alongside our long positions or wait for a short signal, which is there, and that's going short. So we'll see what happens by the end of the webinar on that one. I take it that the market's continuing to, and I've got my team looking at this at the moment. So they will have, look at that. That's PayPal, which I showed you earlier. And I said we were short. Now it's fallen even more. So we'll be adding to that position, that winning position at that dotted line, because it's fallen even more. Okay, it's gone past that line. That's simple. So somebody in my team will be looking at that and they'll just add another position. You don't have to. That's more advanced. You don't have to. Okay. But what I'm saying is, because of the advent of computers and algorithms and all the rest of it, these trends they no longer last weeks on end, which is what they used to do. It's meant there's more volatility. It's a bit like climate change. There's more volatility. Okay. Algorithms are to the market what carbon dioxide is to the environment. It creates more volatile weather conditions. And it's not a bad thing for the markets. It's a bad thing for the environment, but it's not a bad thing for the markets, because it means that in that volatility, timeframes have shrunk. So people like Stanley Druckenmiller, who is a billionaire hedge fund manager and about 90 years old, is leaving because this is the new world. He can't handle it. He's used to having a cigar at lunch and discussing with his friends, well, yes, I think we'll all short sterling tomorrow, shall we? And he can get back in the afternoon, put the trade on the next day. It's going to last for about a month. That's all gone because algorithms make everything shorter and shorter and shorter. Okay, and we don't try and beat those algos. All we're trying to do is ride their coattails. Okay, so this is one I did earlier to show you FTSE for this month. Well, actually for the past 4 weeks. Yeah, 20th to the 26th. Okay, and this is the FTSE, and these were the trends that happened. So you can see what we're trying to do, right? That gets in there. Okay, that signal. Now, we didn't get in at the bottom because we can't see the bottom. We didn't get in at the bottom. We can't see the bottom, okay, because we don't have a crystal ball. We're like Winton. It was a little bit later. That's a profitable trade to that point. That was a losing trade, look, because initially it was winning and it was great, great, great. Then it gapped higher. So, you know, we had to share your pain. But we then had a small win there. That's a small win there because that's short trade. That's a bigger win. That's a loss, right? That's a loss. What? 2 losing trades? You must be rubbish. Look at the size of the blue arrows, which are the profits, to the size of the loss-making ones, okay? And then the short and the long, right? So that was up to the point where I did the slide to showcase, or rather somebody in my team did the slide for me, right? The point of that is that's the goal. That's what we're aiming for. That's why people trade, to capture some of those moves. These moves I can't control. I can't control. I'm just riding the trends which are put in front of me, right? Okay, this is sterling US dollar, just to show it's not a new thing. Trend following, this is from a few years ago, and you can see again, similar kind of issue. That's all it is. That's all it is. And it doesn't matter whether it's an index, and that's why I wanted to show you currencies as well. We don't mind what it is. There's Bill, my mentor, one of my 10 mentors, who I met when I wrote Mind of a Trader Lessons in Trading Strategy from the World's Leading Traders. His boss was that man, Warren Buffett, who was chairman of Salomon Smith Barney. Again, if you're waiting to be right 80% of the time, you'll never make it as a trader, and that's a mistake a lot of people do. Because what they do is they take that and then they hold on to their losing positions thinking, oh no, I've got to be right 80% of the time. This is losing. Therefore, you know, they started off with the wrong premise that they've got to be right 80% of the time, and they get a losing trade. So they think, therefore, I'll just keep holding on. Okay. We don't gamble on news. Nope. And we're not into forecasting, as I've said, because forecasters are flummoxed. Most of the time, we're not into forecasting. What we're doing is following those trends. We're getting in after the trend starts. Does that make sense? We're not getting ahead of the bandwagon. We're jumping on the bandwagon. And if should the bandwagon fall, we'll go short and ride it on the way down as well, right? So I'll tell you about entries in a second and a business plan. Before we do that, I don't know who SpreadX are, but this, and I'm not endorsing them. I know why you're here. This is why people are here. They see this on. And by the way, what I'm talking about applies whether you're spread betting, CFD trading, options trading, trading futures, trading cash. Doesn't matter because it's buy low, sell high. It doesn't matter the instrument you use to do it. So they'll say, oh, I want to do this. I read these figures. Forget it. Those aren't our goals. I'll tell you what the goals are. The goals that I tell people are, first of all, you start off with the demo account, so you're not risking any capital. Why would you take a brand new car if you're learning to drive on the motorway? You wouldn't, would you? Because you crash it. Similar with trading. You don't go with live cash on day one if you're new to it, right? Or any new strategy. You start off with a demo account, so you don't risk anything. That's the clever thing to do. But also what we're going to do is we're not going to target some crazy numbers like this. The difference between rich and poor for most people, and most people are on here because they want to just have a little bit extra to top up their rent, mortgage, their kids' education, or their kids' rent or mortgage, or pay off credit card debt, or pay down credit card debts. So the difference between rich and poor for most people is about $500 a month. Now, I know some of you think, oh, it's not. I need $500,000. Have you met my spouse? No, it's about $500 a month. So we're going to start off with, let's say we can learn the skills to make $500 a month. If you can make 500, you can make 1,000. If you can make 1,000, you make 2,000. The markets don't guarantee anything. It's not a job. Okay, so you're not going to get 500 a month. Some months you get more. You save that for the month in which you get less, so that we average it out at about 500. That's not going to come from day one. That's going to come from learning the skill first. And only when we've learned that skill on a demo account would we go with live cash. And if we never learn the skill because we're just not made to drive a car, then you'll never have lost anything and you'll know trading is not for you. But for those for whom it is, there's only about 10% who just can't ever pick it up, and that's fine, or don't have the time, or whatever, other things get in the way, or they just don't have the inclination, they don't enjoy it, that's fine. But for the others, if you can, we want to master that. So 500 is our goal, not loads, all right? These are the important numbers by which we're going to do it. I want to scan for 15 minutes about 12 to 20 products. Now, you might say, okay, I must need lots of screens. No, you need one screen. We're going to do one quality trade a day, which is 20 trades a month. And I'm going to show you on a business plan in a second why that is ample, all right, to make you happy and give you the money you want. So you'd have a look at this. You go, okay, and we'd have 12. I've not put 12 up there because you won't be able to see anything. The screen will be too jammed up, right? And what we do is we say, right, we'll scan that for a signal, just like we had a minute ago with well, we've got one now. Look, there you go. Australian dollar, Japanese yen. So that one went up a bit and then got wiped out. So we're short on that one. Okay. Currency, minor versus major. Japanese yen, short. All right, got a signal. Fine. Is it a quality signal? Yeah. Why? Because we know we've got a quality strategy, right? Not every trade's a win, but that one looks strong. Great. Boom. In. So you scan it. So we're not spending too much time because it's about return on time invested. Everyone always says to me, oh, can I look at it on my phone 24 hours a day? Why? Are you trying to avoid your spouse and kids? Because, why do you want to be glued to your phone? I don't want you glued to your phone. I want you to be looking at it, setting the trading stop. Now, I'll tell you why. In not just our experience, but others, the more time people spend in front of the computer screen on trading, the more likely they were going to do bad trades out of boredom or out of revenge trading. Okay, so we want to limit that, and we want to get a better return on time invested. I wrote an article in the FT many years ago where I calculated mathematically, because people were spending too much time trading, they were actually reducing their hourly rate to the same rate as somebody working at McDonald's, right? That's one of the reasons why we want to keep it like this. Now, remember, losers add to losers, winners add to winners. Stop loss further away if the market is more volatile, and smaller size trade accordingly if it's more volatile. Those are the rules. Those are the rules we're going to apply. Another important rule I want to tell you. We found this statistic from a major brokerage when I was writing a book about 5-6 years ago. Percentage of profitable traders grouped by average trading equity by account size. Now, I'm broker independent. I don't care which broker you go with as long as they're FCA regulated, okay, or regulated in your domestic jurisdiction. Do not ever go with anybody regulated in, I know there's somebody here from Malta, or Cyprus. Certainly not Cyprus. Malta, I'll have to look at it and see, but Cyprus, never. All right? Freaking cowboys, and their regulators are cowboys. You can tell them I said that. They're trying to clean things up. They're rubbish. They'll just steal your money, guaranteed. Right? Now, this is what we found. Right? If you've got over $10,000 in your account, you've got a 43% chance of being profitable. Remember right at the start, I said 66% of people lose money? That was right across the board, including the small account sizes. So why is it people are more likely to lose money if they've only got $1,000? Because guess what? They've only got $1,000. Their trade size is going to be too large proportionate to their capital, and a small move in the market is going to wipe them out. So they're more likely to lose. Here, they're going to have the same trade size as if they've got $1,000, but they're less likely to lose by volatile market conditions, and so they're more likely to be in the winning percentage. You've almost increased it to 50-50 chance of being a winner. 50-50. I'll take those odds all day long, because that's just without any training, any skill, any mentoring, any education, any coaching. That's just nearly 50-50 chance of winning. That's better than any business. There's no business on earth which gives you a 50-50 chance of being profitable. There is not a business on earth which gives you that. The statistics are 90% of businesses fail within 3 years. 90%. So 50-50 as a business, I only think of trading as a business, I'll take that all day long. So final two things I want to cover. One, the business plan, how much money can we make? And secondly, what are the rules for entry? I've talked about stop losses, that's the exit. What are the entry rules? Okay, and then we'll go through some of these trades. Again, I'll keep an eye on them as we're looking at the markets right now. I'm assuming there's a pullback. I just want to keep an eye on this as well at the same time. For instance, on the S&P, I assume there's a move down. Let's just have a look at that. Let's just draw that in a bit. There we go. Okay, let's just, let me share my screen with you there. S&P, there we are. Okay, yeah, right. So it's capitulated then today. Looked like it was going to do better, but it's decided, nope, can't hold on to the gains, which isn't a surprise given the strength and momentum. If you followed my Telegram channel, you'll know the strength and momentum is just too strong to the downside at the moment, that any upside moves. And I don't know, I'd say down is more likely. So there we are. That's the S&P 500, but we'll return to it, and I'll explain what these 5 red arrows mean, and they mean exactly what you think. There's a strong move to the downside. Okay. So business plan and then entry, and then that's your lot. We'll do Q&A and everything else. So is it all worth it anyway? That's my mum, by the way, always makes a visit on my webinars. Okay. So how much money can you make to decide if it's for you? Now, trading, given that how quickly I've had to explain it, is a bit like learning to drive. When you first got into the car, if you still remember when you were 17, it looked like, bloody hell, this is complicated. Everybody else makes it look easy. You know, you got a steering wheel, you got indicators, you got rear view mirror, you got wing mirrors, you've got a pedal for acceleration, clutch back in the day, brake, gear shift back in the day. That seems like a lot of stuff. And you got Muppets on the road. So it's a lot of stuff, but you managed it. You managed to do it all, right? Trading's the same thing. You're going to manage it and it's worth it. It's fulfilling. Just like driving, it's worth it. All right. So this was the business plan Bill Lipschutz and I worked through when I was interviewing him when I was a student and I wanted to meet the world's leading traders, and I met him. I met him in New York and in London. We did 2 interviews, one at the Berkeley. They've got a swimming pool on the top, and for some reason we did it, nothing odd, but we did it at the swimming pool level, which is a nice venue to interview someone. And this is because the first thing he said, look, so you think you want to be a trader? Well, have you worked the maths? I thought, shit, he's right, actually. I look an idiot if I haven't even worked it out, right? So he said, now, imagine your maximum loss on any one trade is 1% of your total capital. That's what he said. He said, we'll start off with this. And this is a business plan. It's not where I was as a poor student. I had no silver spoon in my mouth. This is where I wanted to get to. He said, this is to decide whether you want to go down the route. So if nothing else on this webinar, you'll learn whether or not trading's for you. Okay, total capital, assume you eventually get £20,000. Why would you get £20,000? Where the hell are you going to get it from? Well, you get it from friends and family if you're any good at trading. Or you'll have your own capital, but if you don't, you'll get it from friends and family if you're any good. Because you're able to say to them, look, here's my record. That's what I had to do, okay? But obviously the first thing you're going to do is not going to start gambling that on the market. You're going to learn the skills first and then get the capital. Not get the capital and then learn the skills. That's the wrong way round, which is the way most people do it. Wrong way round. Okay, maximum loss per trade, 1% of £20,000 is £200. Assume win-loss ratio, because we've got all these skills of the entry, which I'm going to show you, momentum-based entry, which will come next. So you're better than a 50-50 coin. You're better than a 50-50 coin. 60% of your trades are winning, 40% are losing. So you're better than a coin, all right, which isn't a big thing to ask, all right? And let's assume, I think PayPal's falling below, I've got a price of 156 on there at the moment. So that's falling more, which is good. Good, not for my long-term investments, but good for my short-term trades. So I'm happy, can stay calm. I don't panic on my long-term investments, so I'm making money on the trades. You see how trading and investing is correlated? Average loss will be £200, 1% of 20,000. Okay. This is his. We're just working a very simple, basic business plan. Average win, because winners add to winners, will be bigger than our losses, because winners add to winners. So we'll pick a strategy where we make £300 when we win, i.e. our win should be bigger than our losses. Let's say we do 100 trades, and he's running through the numbers with me. And remember, I was a young student at university, didn't have a lot of money. And he said, oh, wait a minute, that means you make 60 times £300, profits of £18,000. At this point, I said to him, Bill, call my parents, tell them I'm dropping out of university. All I want to do is trade. I want to sit at home, bang a keyboard, wearing my underpants and eating nachos, getting fat all day long. That is the dream of every student, making money. Who knew it would become a reality 20 years later for so many young people on the internet nowadays? Back then, there was no internet when I first interviewed him. Well, there wasn't really an internet. 60. And he said, hang on, Alpesh, calm down. And he was right. He said, what about the losing trades? I said, yeah, but Bill, 40 times £200, okay, losses of 8,000. That's still £10,000 per 100 trades. At this point, I was going berserk. I said, you know what? I'll be a day trader, because that was the term at the time. I'll do 100 trades every week. I'm going to go nuts. Bill, I'm going to go nuts. I want to leave university. Forget being a lawyer. 50 weeks a year, because the other 2 weeks I envisioned I'll be on this yacht or private jet or whatever. I don't have a yacht or a private jet. 50 weeks, 5,000 trades per annum, £100 per trade. That's 500 grand, Bill. That's amazing. I'm laughing. It's all I want to do. I know what you're all thinking. Don't be stupid, Alpesh. Okay, we're not going to do 90% of that. We're not going to do 3/4 of that, Alpesh. We're not going to do 2/3, a half, or even a third or a quarter of that, Alpesh. We're not even going to do a fifth of that, or even 15% of that, Alpesh. Let's say we did 10% of that. Let's say this business plan, stylized as it is too over-optimistic, like all business plans are. So we only do 10% of that. There's still a problem if we do 10% of that. Let me take that as a pen and draw something. If you did 10% of this business plan, that's 50,000 a year. That's still too much. Too much in this sense. Our goal is for 500 a month. So we're being over-optimistic. And that was his point. He said, calm it down. When you're deciding whether or not to do something, you don't get carried away by an over-optimistic business plan. Let's calm it down and look at more realistic levels. So I said, well, what the hell's a more realistic level? And he said, well, let's have a look. If I can find where my mouse has gone, there it is. Let's have a look. If you just keep your day job, he was very keen. I kept my day job, and he didn't speak to my parents about me dropping out of university after speaking to him. So let's keep my day job then. Okay. And that's 100 trades per 6 months, one a day. He said, keep your day job, whatever you're doing in your world, keep doing it, diversify your income streams, multiple independent revenue streams, as was the terminology of the day. 100 trades per 6 months is one a day. That's 200 trades per annum. Well, at £10,000 per 100 trades, that'd be £20,000. And I said, wow, that's amazing. Okay, I know it's not the 50, which is 10% of the original business plan. It's about 4% of the business plan. I was still happy with that. So I said, wait a minute, hang on. And you should be asking the exact same thing I'm about to say to you. Hang on, Bill. If this is right, how come everybody isn't rich? And he said, well, the reason everybody isn't rich is 1, bad teachers, 2, bad mentors, pretty much the same thing. 3, bad strategies. Let's focus in the last part of the webinar of strategy. Let's look at the entry strategy that he said to me was best suited to me as a poor student. It's now one of the 10 we use in the hedge fund. It's not the only one, but it's my favorite one because it's my firstborn one, and it was thanks to him. So let's look at the strategy that he said. Okay, remember, just as a quick recap, what are we looking at? There's my mum again. 100 trades per 6 months, 200 per annum, 20,000 per annum. No, we're not. Pay attention. 500 to 1,000. Let's say 500 to 1,000 a month. We're looking at 12,000 a year max. So not even that. So we're not looking at even 4% of the business plan. We're looking at what is it? 1.8% of the business plan, roughly, something like that. Okay, that's what we're looking at. That's a good business plan. That's worth pursuing. That's worth taking to the next step and saying, listen, I'm not trying to hit this business plan, which is always over optimistic. I'm just trying to hit about 2% of it, or 2.2%, sorry, of it, or 2.4% of it is all I'm trying to hit. That's good. We're trying to be this guy when we're momentum trading riding the coattails of the market that's already moved. We're not trying to stand in front of Goldman Sachs or whoever's moving the market, Winton Capital, Renaissance Technologies, AHL, Aspect Capital. We're not trying to stand in front of them, Brevin Howard. We are trying to ride their coattails. Okay, we're not trying to outsmart them. We're not trying to out-analyze them because we can't. I don't have, in my fund, I don't have enough money to pay for dozens of analysts. We pay £15,000 a month in rent, right? Do you think we can afford, and I wish we owned the office in Mayfair, the whole building. I'd do nothing else. But no, you think we're going to go around just paying for lots and lots of analysts? How many would we need? Loads. 1 or 2 won't do it. 10 won't do it. So we'd rather ride the trend. You know, if you can't beat them, join them. Be in on their coattails. So how do we do that? And this is what Bill said. He said, look, you're not going to buy some expensive software and all the rest of it and hire lots of analysts because you're a student. So let's look at something simple you can do by amending all the best practices of the hedge funds that we've already discussed. And as well as that, okay, keep it simple as is suitable to a private investor. Remember, I was a student at the time. So he's not going to go and tell me about, you know, merger arbitrage, for God's sake. So what did we look at? Well, what we looked at was, we said, look, use the tools which are already available out there. All right. I'll try and get rid of that arrow. There we go. No, I haven't. Okay. Look at the tools which are already out there. And what we want to do with the tools which are out there is we want to try and look for momentum, i.e. will the price most likely, more likely than not, move up in the next period? I said, how do we do that? And he said, well, look, if the price closes near the high, that's momentum, right? Whatever period you're looking at, 15-minute, 30-minute, 1-hour bars. Okay, remember all that data I showed you was free and live and real time forever from a multitude of brokers. We can discuss how you get it in the Q&A in a second, right? So you can play around with it, which is great. No cost. I love things which are free, right? So price closes near the high, more likely to go up. And I said, okay, explain that. And he said, well, it's like those auctions. Momentum is like, oh, I've got 50, anyone give me 60. I've got 60, anyone give me 70. I've got 70, anyone give me 80. I've got 80, anyone give me 90. It's a bit like that. I said, well, how the hell am I supposed to measure this? What, with a magnifying glass, looking at every single market that I just showed you? That doesn't make sense. And he said, no, there's indicators out there which do it for you. And I said, well, they better be free. And he said, well, we'll have to look at the free ones for you, but we'll do 3 things that all hedge funds do. We won't just use one indicator to measure is the price closing near its high. We'll use multiple indicators, so we filter. That way, we've got less chance of being wrong. Second thing is we won't just look at the time frame you're looking to trade, like the 15-minute. We'll look at the next time frame along, because guess what? Some people are looking at that. And you want to have advance warning, don't you? If there's a deluge of sell trades coming your way just because you got a bit of a move up and then it falls. You know when sometimes you bought something and immediately it fell? Does that happen to you and you thought, God's out to get me? Does that happen to you? Well, I've got to tell you, I spoke to God this morning and he is out to get you. No, it's not that. What it is you didn't look at the next time frame along and the deluge of money coming to short things, which was already on a downtrend. So your little up move made you falsely think in your little world of 15-minute bars, oh, it's turned, let me get in. But you didn't look at the next time frame, which was going down. So he said, we'll look at the next time frame. We'll look at multiple time frames. So multiple indicators to measure is the price goes near the high, multiple time frames, and finally PC. And I'll explain what PC is in a second. So there were 3 things. Now there's lots of indicators. These are complicated mathematically. You don't need to learn all this. Guess what? Computer software just does it for you freely. You know, like the stuff I showed, does it for you. All right, great. And what they're all doing is measuring in different ways. Is the price closing near the high? And or is the price making higher highs, which also suggests momentum, and or is it making higher lows? So there's lots of ways of looking at momentum. So we're going to look at multiple indicators so that we don't misinterpret and so we can filter. So we need these multiple indicators. And he said, we're going to use them in a way the textbooks don't. Because if the way the textbooks did it, well, great. Those people wouldn't be writing textbooks. They'd be trading, wouldn't they? So what we're going to look for, unlike the textbooks, is are these indicators, whether it's the MACD, the stochastic, are they flat? See that? Flat to rising, flat to rising, flat to rising. Can you see that? Flat to rising. That suggests momentum. Because many of these indicators are lagging, we need to look at them earlier. So not when they're already rising, but when they're just starting to go up. And we get confirmation from multiple indicators, flat to rising, measures of momentum, and multiple timeframes. So we're more likely to be right, okay? More likely, not certain, not guaranteed, more likely. The probabilities have increased because we're filtering. I'll recap that in a second. That's our entry. And the final thing was PC. So multiple indicators, multiple timeframes, flat to rising. PC is price confirmation. Has the price made a 2-period high? Why? Because that's the only thing which tells us that other people have seen what we've seen, i.e. momentum, are putting money behind it and confirms it, right? So PC is price confirmation. We now in the fund use pattern recognition, but you don't need to worry about that. We use 20-period historic patterns, and we've got a library of patterns which you can't even give names to because they're also different, and to see if there's an increased probability, because that you don't need to worry about that part. Okay, so why is the system effective? Well, it's triple filtered, like a good cigarette. I don't smoke. Triple filtered to ensure optimal entry, MCQ. What do I mean by that? First, we measure the momentum to ensure consistent positive buy signal, right? Positive, in other words, multiple indicators, flat to rising, multiple indicators, whether it's MACD or stochastic. Measuring is the price closing the higher highs, higher lows. That's the first thing. Second thing, we confirm it across multiple timeframes, multiple indicators, multiple timeframes, and we qualify that by price confirmation, right? Has it actually made a high in the next period? That's what it is. Those are the rules, right? So let me explain that, okay? Let me explain all of that. Let's just look at that PayPal again, one from earlier on. All right. So if we look at the PayPal one, where we had the buy signal there, it's fallen, it's come up a little bit, right? What's going on? Well, at that point, multiple indicators were flat to falling because it's a short trade, flat to falling across multiple timeframes, not just that timeframe, but multiple timeframes. That's what's going on, right? And there was price confirmation. The price made a 2-period low. So we then put it into the computer system to do the work for us. That's how we get our signals, right? Got it? That's how we get. So I'm giving you the rules. I'll show you if you want to download it in a second, how you can download that as well. We then use the rules also to give us a stop loss, which is very simple. What's the volatility? And we just put the stop loss based on the volatility at a safe distance, not too far, not too close. It's the principle that's important. Parallel to that is that dotted line, which is where we add to winners. Okay, so that's that. This is just an indication of sort of like traffic lights. Where do all the signals sit? Okay, and this just gives us the numbers of where those lines actually are, so we can actually see the raw numbers. So we just get it made it a lot easier for us, so we don't have to do it manually. Back in the day, I had to do this all manually. Okay, once Bill had taught me, I'd have to do this manually, and that was painful. Don't bother trying to have a relationship if you're going to do it manually, is all I'll tell you as advice. So what are the kind of people who are trading? This was a talk I gave at Bloomberg a while back, pre-COVID, obviously, right? Who are the people? Who are these people interested in trading then? When I've just described it, for who's still on the talk, for instance, who's still on the call? Who are the ones still interested? These are the ones that are still interested. They're students. We've got full-time mums, full-time plumbers, professional traders, obviously school teachers, people who are in between jobs, side gig entrepreneurs. We're living as side gigs didn't even exist. People didn't even know what side hustles were before. I'm going to put a poll up just so we can get even more of an insight of people who are here. Okay, that's what we find, which is nice because it's democratized it. It's become universal. Trading online, from when I wrote that, 22 years ago, and 22 years ago it became an international bestseller. Trading online has become democratized. Okay, so what I did, I developed this when I was at university. That's me, red carnation, last exam, white bow tie, because that's how you take exams, obviously. Perfected the strategy, won awards for my investment knowledge. The publishers, Financial Times, then said, look, would you like to write books about this because you're good? I said, yeah, I want to raise my profile, because the obvious thing to do